Options trading used to be so freaking easy. You could sell a call or you could sell a cash secure put, and you can make money like no other. It was the decade of free money. But now, of course, the Fed is reversing course on what they've done over the last couple of years, which means that free money is no longer available. Everybody was sold on the idea of easy passive income by selling these cover calls and these cash secure puts, but then the Fed rug pulled us, and now if you sell a put option, you risk the stock falling by 40% in a month. Looking at you, Tesla. So in today's video, I'm going to be explaining why these strategies aren't easy passive income anymore, and we're going to explore some alternatives. Why can't we use these strategies for easy income anymore? It's because they're capital intensive, and the best thing that you can have right now is cash. Cash is king during times of quantitative tightening like we're going through right now. We're experiencing record QT to where the Fed is basically rug pulling the market, trying to pull all the liquidity that they forced into the market over the last couple of years. And the people that are in the best position right now are the people that have a lot of cash in order to buy the dip. And while you can start buying the dip now, it's probably going to last a lot longer than most people anticipate, because the bond market expects the Fed to pivot over the next 6 months to 1 year. But the Fed itself has said that they're not going to pivot until 2024. So right now is probably not the best time to use these capital intensive strategies when the best position that you can be in is cash. Because the stocks that you want to sell these cash secure puts and these cover calls on are likely to continue to drop unless you're picking the right sectors, of course. You could pick maybe staples like McDonald's, or you could pick maybe something like Coca-Cola, things that people still need during a recession, or think they need at least. Nobody needs McDonald's. But these stocks typically still do well during times of recession. So staples, industrials, those are okay places to put your money and to sell cash secure puts and cover calls on during a recession. But the usual tech stocks that we're used to selling these options just aren't viable stocks anymore for cash secure puts and cover calls, because they're likely to continue to come down over the next year as the interest rates continue to go up, because borrowing money to grow the company is going to be more expensive for them. So whenever you sell these cash secure puts and these cover calls, you risk the stock coming down, which means that you're going to be losing money on the stock dropping in value, because in order to sell these cover calls or sell a cash secure put, you're going to have to buy 100 shares of stock, and you risk that stock going down in value, which is going to bring down your overall portfolio balance. You will still be making income by selling the cover calls and the cash secure puts, but the income might not make up for the drop in value that you're going to experience because of the quantitative tightening, the higher interest rates, and the stock falling. Back in March through about August, I was selling cover calls on AMD stock while it dropped from $120 all the way down to about $80. And with those cover calls, I was able to break even, but I wasn't able to come out with any profit for that trade. And that might be the same situation that you find yourself in if you start selling cover calls and cash secure puts right now. So you're taking on a major risk by buying stocks right before a recession and during a time of quantitative tightening. You're risking a lot of your capital, a lot of your cash, and you're possibly risking your time, because there's no telling how long it's going to take for these stocks to recover. And you might still have like a long-term outlook for the stock market and for the stocks that you want to buy using cash secure puts and selling cover calls. You might have a 5-year timeline, and that's fine. But if you want to make money right now, then selling cash secure puts and cover calls probably isn't the best method, because it might take years for the stock to get back to your break even for your cash secure put that you used to originally buy the 100 shares of your stock. And that's not to say that these strategies won't work in the future. I'm sure that they will once we get to a period of quantitative easing. But right now we have record QT, so these aren't the best strategies to use. If you are dead set on using these strategies, though, you can still use them, but you want to change the delta value of the options that you're selling to open. So delta is an estimate of the percent chance of your option expiring in the money. So the lower your delta value, the less likely you are to get assigned to have to buy or sell 100 shares of your stock, depending on if you're selling puts or if you're selling calls. So a low delta value, in my eyes, used to be about 20 to 30, which means that there was about a 20 to a 30% chance of the option expiring in the money to have to buy 100 shares or sell 100 shares of the stock. But now I think that low delta value is probably below 10. So about a 10% chance of the option expiring in the money to getting assigned. But the lower your delta value that you sell for a cover call or a cash secure put, the less credit that you're going to get from that option. Because the less risk that you take on, the less reward that you're going to receive. And whenever you sell these low delta cash secure puts or cover calls, it doesn't really reduce the amount of capital that you're putting up for your trade. So you're still having to put up a crap ton of cash in order to continue using this strategy, which is where my second alternative comes in handy, which is spread options. With spread options, all you need is the difference between your strike prices. So whenever you open a spread option, you sell one option and you buy a separate option with the same expiration date. And since you're buying an option on top of selling an option, you have the right to buy 100 shares or sell 100 shares, depending on if you have a call or a put. And then you're buying or selling the same 100 shares with the option that you sold. So you don't risk having to buy or sell 100 shares of a stock yourself. Instead, your broker is going to facilitate this trade to where they're going to buy and sell the same 100 shares of the stock on your behalf. So there's no risk of buying 100 shares and having to bag hold those shares for years, which is the main benefit of spread options. Now, spreads are going to require a lot more time and effort. So this isn't going to be a passive income stream by any means. You're going to have an ear on the ground listening to what's going on in the market, how it's affecting the stock that you're trading spread options on. And you need to learn how to manage your risk a lot better than if you're selling cash secure puts and cover calls. Because with a spread option, you have what's known as your max loss. Whenever you sell a cash secure put or a cover call though, you risk the stock going to zero. And the likelihood of a stock going to zero, unless you're picking something like Carvana or Nikola, it's pretty damn low. As long as you're picking a solid company, the chances of the stock going to zero and taking your max loss for selling a cash secure put and a cover call is very low. But with a spread option, the odds of you taking your max loss is a lot higher. You just have to be wrong about the strike prices and you lose whatever you put into your trade. And that's part of the beauty of this strategy too, is you know exactly how much money that you can lose with each specific trade that you put on. So if my max loss is say $50, that $50 is all that I can lose from this trade. But you can use risk management strategies like cutting your losses at something like 20 to 30%. The way that I cut my losses is based on mental probabilities, but that is more of an advanced strategy. But having your risk management down pat and knowing when to cut your losses is what will save you using this strategy. If you don't learn about risk management, then you'll end up like I did a couple years ago to where I lost $12,000 or about 30% of my portfolio on a single trade. But this strategy is really great for basically any account size. You can start by using just $2,000, and you will need to start with $2,000 in order to have a margin account in order to trade spread options. But you can start with just $2,000 and work your way up to hundreds of thousands of dollars using spread options. This is the best scalable strategy out there. I've been using it since I started with $3,000. I'm still using it now that I have $10,000 that I'm using to trade options, and I'm planning to continue to use it once my account reaches $30,000 for options trading. Now, liquidity or the ability to get in and out of your trade is going to become harder as your account continues to scale higher and higher. You'll have to take on more spread options, but there are a couple ways that you can mitigate this risk. You can trade very high volume stocks. Think of SPY, Tesla, or Apple. And then you can always widen the strike prices that you choose whenever you open these spreads. That'll reduce the amount of spreads that you need to open, which means that you're taking on less spreads, you're paying less money in commissions, and overall it'll be easier to get in and out of your trades. So whenever you're scaling up your account to tens of thousands or hundreds of thousands of dollars, You're going to need to focus more on liquidity using these couple of methods. But overall, this is a really great strategy for saving your cash since you don't have to buy or sell 100 shares of a stock. It is going to require more time and effort on your part, so it isn't passive income like you were sold on. But in the end, you don't have to bag hold a stock for years on end, waiting for it to recover. That way you can start selling cover calls again. Maybe whenever quantitative easing comes back in probably 2024 is my best guess based on what the Fed has told us. Then we'll be able to live on our yachts, selling puts and selling cover calls on Tesla or whatever stock is popular at the time. But for right now, this just ain't it. Hopefully this video helped you to save some much needed cash. Thanks for making it all the way to the end of this video, and thank you to all my patrons for their support. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys.